Hello everybody, today we have the pleasure to host Paul Reed. He is the head of fixed income of Invesco, and of course we will discuss with him some topics regarding central banks, so monetary policy and the perspective of bonds in general. So let me start with the first question, Paul, about the Federal Reserve. About a year ago, market were expecting a much more active Federal Reserve. And so, we were all preparing for a higher interest rates, higher yields on bond, and 1 year later, we are way from that kind of forecast. And so, can you tell us what you think about the next, let's say, moves by the Federal Reserve? What is the perspective for, U.S. bonds?
Well, you're right. A year ago, we thought, and even the Fed essentially hinted that there would be several rate increases this year, and we haven't had one yet. I think that there's a reasonable chance that the Fed does something in December, and I think that they would like to raise rates a little bit, even just to get some cushion for the next downturn, so they can do something in terms of loosening policy eventually. But I think that we're going to see the same pattern for a while now, with very cautious central banks, very slow moving, probably less tightening than was originally predicted. But I think in the U.S. that we will still see some, but it will be modest. And in terms of growth for next year, I think the U.S. will continue to essentially lead G7 in growth. But again, I think it, in historical terms, is relatively modest, but in G7 terms today, still a global leader. So it's probably a continuation of a low growth, low inflation, low interest rate environment for some time.
And Paul, now moving to the European Central Bank. The European Central Bank has been pretty late in implementing QE, but in less than a year and a half, they've already purchased a huge amount of bonds, over €1 trillion, and now we have basically negative yields, for a big chunk of our government bond market. So, and inflation, to be honest with you, is even lower than where it was when they announced this purchasing, of government bonds, and lately also of corporate bonds. So what do you expect the European Central Bank to do, considering the fact that if they don't extend the program, it will expire in March 2017?
Well, I think what you've seen from Mr. Draghi, what he said all along, is that he'll do whatever it takes. So I think the fact that officially the program expires doesn't mean that it will expire. I think he's shown willingness to use the balance sheet, and will continue to want to do that. I think that they are, like all central banks, are realizing that they're probably at or near the limits for what they can do in terms of cutting short-term interest rates, because no one likes negative interest rates on deposits or short-term government bonds. It's difficult for banks, and it's difficult for savers, and ultimately you can take your money out of the bank and put it in a safe. So I think they're reaching the limits there, but I don't think necessarily they've reached the limits for what they think they can do in terms of quantitative easing. And I don't think the fact that the program expires should mean that we manage to some sort of cliff type event. I think you would not bet against Mr. Draghi and the ECB for doing even more and being even more aggressive until they get the results that they want.
And now moving to Japan, the Central Bank of Japan probably is the #1 central bank in terms of very creative ideas to provide, stimuli to the economy.
Yeah.
Do you think that they have much room left in order to provide stimulus to the economy?
I guess by definition, they can't have that much room left. And they're clearly trying new ideas. They're talking about trying to somehow engineer a steepening of the yield curve. I think this is going to be quite difficult to accomplish, really. because in a yield-starved world, excuse me, the moment you get a slightly steeper yield curve, you get yield-starved investors wanting to invest. So I think it's a really tough thing for them to do, and they've been doing this for a long time, and they're probably near the end of what they can do. And for the Bank of Japan, I think that the exchange rate is maybe one of the most important things, and maybe they can do something to try to influence that. That's, again, difficult because we've seen time and time again that the yen rallies when markets get risky, and it's hard to fight. So I think that there are things they can do. They can talk about QE being permanent, never selling back what they've bought, letting it mature, and then reinvesting. So there are things that they can do, but we've been in this a long time. So I think we're, as you say, probably near some kind of limit.
So Paul, in this environment of negative yields, zero yield, or in case very low yields on government bonds and investment grade, everybody has, let's say, increased the exposure to high yield and emerging market debt in order to deliver some sort of positive yield to clients, and we have done that as well, of course. Do you still see value in these, bond markets, high yield and emerging market debt?
Well, it's true. Look, there is a terrible shortage of yield in markets, and by definition, what the central banks are trying to do is force people to take more risk, and that is happening. And I think that in broad terms, high yield is still relatively attractive, but I think you have to be careful. You have to really be careful about the credit risk that you're taking, careful around idiosyncratic risk, stock-specific risk. So probably the safest place to be is in the higher quality and more liquid, higher quality end of the high yield market, and not in the tail of the high yield market, not in the more stressed credits, where I don't think you're being paid enough for the real pure credit risk. But in terms of the spread for high quality, high yield, this is a place where you can, admittedly with some more volatility, earn positive yields, which is, as you said, there are negative. Most government bond yields are 0 to negative. We've got corporate bonds now trading with negative yields. So there is a desperate need for income, and I think high quality, high yield is a place where you can get it. I think emerging markets can be a source of income, but I think, again, you have to be very careful. I think there are headwinds. I think there's more political risk. I think if the dollar strengthens and commodities stay weak, there's increased credit risk. So within the emerging markets, I think, again, you have to be quite careful about credit selection and look for credits where there's global diversification. So maybe it's an emerging market credit, but really a global player and with big market shares and strong balance sheet. That's the sort of thing that's relatively safe. Watch out again for cyclical risk and stock-specific risk in EM credits.
Paul, of course, one question about Brexit. Actually, markets did not react in a negative way. After a few months, we are still higher than before the Brexit. So my question is, what would you expect now to happen in, let's say, the next couple of years? What do you expect, politicians will actually do?
Well, I don't think anyone can answer the political question for sure, because there's a lot of uncertainty, and I think there's a lot of uncertainty within the British political system about what they want and what they can achieve. I agree with you. I am surprised, really, with how markets have reacted so easily to the Brexit vote. I was quite bearish about it. I think that we need to separate short-term and long-term implications. In the short term, I think the UK consumer doesn't notice anything different. The pound is a bit weaker, more tourism, we had a nice summer, so the consumer confidence has been okay. I think the investment side of it is longer term, and I think there will be a pretty big headwind for investment, either foreign direct investment or UK investment, while there's this period of uncertainty. So I think the UK economy has a headwind, a real growth headwind next year and the year after. And I don't think that's completely priced into the risk markets, at least, for the moment. Longer term, who can say? It really will depend on what the British can make of the negotiation and how successful they are in terms of becoming continuing to be this open and global trading country.
Okay. Paul, one final question, and this is about the banking sector, which has been really very badly hit, especially here in the Eurozone. And I would like to understand whether you are actually investing in some of the, banks' bonds, if they are investable according to your criteria, if you are waiting for something to happen before investing in them. What is your stance on European banks' bonds?
Okay, well, in broad terms,
Yes.
our stance on European bank bonds is reasonably positive. I think we have come an awful long way from where we were between 2009 and 2012. There's an enormous amount of capital has been raised, and a lot of liquidity has been raised, and a lot of balance sheet reduction has taken place. So the credit side of it is much better than it was. And the pricing is interesting. It is one of the places in the fixed income world where you can get attractive yields. You need to be careful about from credit to credit, but in broad terms, I think it's an interesting part of the markets. You're right that it's been under some pressure, but over the last, say, 3 years, actually, on a total return basis, parts of the European bank financial markets have been among the best performing asset classes because there's a lot of income, and for a long time it was relatively stable. And recently prices have been moving. Recently, I mean the last 6 months, there's been some move back in prices. You have to be careful stock specific, but here and there, stock specific also looks quite interesting, particularly in some of the peripheral bank names where I think some of the selling is probably overdone. So it's an important part of the market for us, and I think it's an attractive place to find income. I think you have to think about it within the construct of a portfolio. So you need to be diversified, and you need to be in a diversified portfolio. Buying one or two bonds, you could end up with one of them is a problem. So on a globally, in a diversified portfolio, I think it serves a purpose. Yes.
Okay, Paul. Thank you very much for your time. It was really appreciated.
Thank you very much.
And good luck.
Thank you. You too.
Thank you very much to all for your attention.